say similar, but in terms of the topic and the coverage, it was around the investments made by Singapore companies into India. So what are the tax implications? What are the mode in which the investment, etc., can be done? All that was covered as a part of our earlier webinar. Now, considering the responses and feedbacks received, we've tried to modify this one a little bit more. And we've tried to cover a few additional aspects. Of course, given the limitation of time that normally bars most of the professionals who are attending the course, we've tried to keep this as crisp as possible and more on the practical aspect. So the format of the webinar today would be that we would be going through the slides that have been prepared for investment into India. Once the session completes, you can leave your questions or your feedbacks, etc. Anything which is there on the chat box, which is available to you. And for those of you who are looking at similar webinars in the future, you can follow us to stay updated about all these further events that we will be doing. The next one which we will be doing will be most likely around the taxation of crypto, because that's one aspect which many people are struggling right now. So we'll discuss more around that particular part. But for now, let's delve down a little bit deeper into tax implications for investment from USA into India. Now, generally, if you see in India, a large part of the FDI is made by US entities. Now, it's a different matter that this might be routed through Mauritius in the past or Singapore, if you see right now, for various tax reasons that is there. But US happens to be one of the largest FDI investors into India. And therefore, it becomes important to see what will be the tax implications if the investments were made from US into India. So in our examples that we're going to see, we'll see both the cases where the investments are made directly by the US entities into the Indian company, as well as the intermediary investment. For continuation's sake, we've taken the intermediary jurisdiction as Singapore only, because what are the tax implications if a Singapore company exits from India, etc., is what we discussed in the last webinar. So this is also going to help you build through your knowledge on direct as well as indirect transfer of shares or capital assets into India. Now, whenever we are looking for an investment or whenever we are looking for an advice to your client, the first and the foremost thing is what exactly does the client, or maybe in case you're working in industry, the people who have entrusted you with the responsibility of structuring these investments, what are the key considerations for them? Of course, all these key considerations end up in one manner, which is that the return on capital is high, and tax being one of the components that eat up big time into the returns, structuring the tax right is something that most of the investors would look for. And in this continuation, the first and the foremost part is, what is the right jurisdiction for investing into India? Now, if we talk about India, USA, or for that matter, India, Japan, these two countries I'm picking up because a lot of investment into India comes from here. If they make a direct investment into India, most of the income streams that they will get, whether it is by way of capital appreciation, etc., they are taxable. Of course, in the case of USA, fee for included services are something which have a very, very beneficial treatment, but that is only one of the considerations. So choosing the right jurisdiction is very, very important, not only from a tax perspective, but also from a stability perspective. So in the past, Mauritius used to be one of the favorite jurisdictions for investors to come and invest into India. But then things changed somewhere around 2017-18, when the capital gains exemption, which was available, was sought to be withdrawn. And then after that, people have been a bit reluctant in terms of investing into India through Mauritius. But the bulk of the case, bulk of the litigation, etc., which is there, which is coming out in the judiciary, is largely related to, or a large part of it is still related to, investment from Mauritius. The second question which comes up is, what is the form of entity that you should have in India? Now, of course, if you're looking for a project execution, you may be opting for a branch if you expect to get a lot of projects. You may think of a subsidiary when you're looking at a long-term investment into India. LLP, of course, is good for people who are into consulting or services there LLP may make more sense. But if you're looking at acquiring companies, etc., this may not be the preferred route. If you're looking at partnering with someone in India, a joint venture, which can again be in the form of a subsidiary or a corporate entity, is preferred. And then there are other things which could be in the form of a project office, a liaison office, depending on what is the requirement of the foreign investor who's looking at investing into India. The second important point is the capital structure. And by capital structure, what I mean is that when a foreign investor puts money into India, it can put in by way of equity. It can put in by way of hybrid instruments, something like a compulsorily convertible debenture, or it could be a loan, which in India is governed by the external commercial borrowing guidelines. Each one of them would have their own set of implications under the FEMA laws, under the tax laws, and not only at the time of investment, but also from a perspective that when this investor earns a return, how do you repatriate back to them, whether in case of loan or CCDs you paid by way of interest. In case of equity, you may pay it by way of dividend. The tax rates on all these differ. So depending on the objective of the foreign investor, you can structure it between them. The next point is around the regulatory aspects. In some sectors, the investment is automatic. You don't need to go and approach RBI or the government of India for any kind of an approval. But there are certain sectors where there are conditions attached to investment, or for that matter, there might be a prior approval that might be required before a foreign investor can invest. So all these things is something which you need to figure out. Repatriation of funds. This is the single most important objective of any investor. At the end of the day, if a person is investing into India, they are looking for returns in the form of maybe, dividend, in the form of interest, etc. Now, there could be certain cases where they might have invested into India to set up an outsourcing center, but indirectly the objective is how do you generate money out of it? So this is one aspect which comes in later, but the planning for this has to be done right from the very beginning. If in the beginning you get this wrong, then obviously at the end there are very little ways to modify this. And we are going to look at each of these aspects a bit more in detail as we go through this presentation. And there are documentation, which could be in the form of a shareholder agreement, a joint venture agreement, or other business agreements that may need to be done. Now, typically, when we talk about investment jurisdiction, most of the time you would find that people are looking at Mauritius in the past, and they are looking at Singapore right now. But if you actually look at it, there are other jurisdictions also who've got a favorable tax treaty with India. So, of course, when we talk about jurisdictions like France, if there is an investor from France who puts money into India by way of equity, the capital gains arising on that will be exempt where this non-resident owns 10%, greater than 10% capital stock in the Indian company. Each of these treaties may have separate conditions attached to them for claiming these exemptions, but there are these other treaties where similar exemptions might be available, which are available under the India-Singapore Treaty in the past. Currently, if you look at it, if I talk about someone who's looking at investing into India in 2022, under the India-Singapore Treaty, the share transfer is completely taxable. The CCD transfer, this is something which can be claimed as an exemption. It's a position which is being evaluated and which is being taken by a lot of big firms in terms of the investment structuring for their clients. Right? For more details, again, like I mentioned in the beginning, there's a complete webinar on this, which you can look out for on our YouTube channel as well. Similarly, when there is a debt investment, which could be in the form of a CCD or otherwise, even these are not taxable on transfer under the India treaty with these respective countries. So if you are a Dutch company who's planning to invest into India, setting up, let's say, a wholly owned subsidiary, you don't need to go out and look out for something in Singapore. Because in any case, now Singapore is taxable. But if you are putting up a 100% subsidiary, because there's a capital gain exemption for more than 10% capital stock, you can always claim that exemption directly rather than looking out for some alternate jurisdiction. So two key forms or two key corporate structure, if I have to put in, of investment into India are company and a limited liability partnership. In a company, most of the investments are done by way of equity, CCD, or compulsorily convertible preference shares. In case of LLP, there are percentage of profit which a non-resident can own, depending on the sector which this is operating. Now, this seems to be a bit complicated slide, but if I have to just summarize this and how this is relevant in the international tax structuring is, when a non-resident invests into India, at the end of the day, they want to see what is the net amount that they're going to receive after payment of taxes on profits by their Indian counterpart, which could be a subsidiary or an LLP, and whatever taxes might have been withheld on dividend, let's say, if dividend is the form in which the return is being given, or interest. Of course, the consideration is that when you repatriate dividend, this is non-deductible in the hands of the Indian company. But when you pay interest, this is deductible. Of course, there are limits to it, which are given in section 94B. But if I just talk about dividend, just to get across the point that I'm looking at, if there's an Indian company with a profit of 100, and it looks at going under two different regimes which are eligible for companies and an LLP, it pays taxes at two levels. First, let's say if it is opting for the 22% regime, it pays 25.17 as corporate tax. The net amount left with them is 74.83. Now, this is the amount they have to use to pay dividend as well as the tax which has to be given out on dividend. So if they declare this entire amount as dividend to the non-resident, they have to withhold a tax and the net amount is received by the shareholder. So basically, depending on what is the quantum of dividend that has been declared, there may be different level of taxes which might have to be paid if you're setting up an LLP structure, if you're setting up a company structure for a manufacturing company with 15% tax rate or with a 22% tax rate. Now, when we look at non-debt instruments through which investment can be made into India, equity is the most common one. And on equity, the return is given in the form of dividend income. The second way in which you can repatriate the money is through buyback of shares. Let me explain how it is different for these two. Suppose a non-resident invests the face value of shares into an Indian company at 100 rupees. The market value of the share, let's say at relevant point in time, is 150. They've got profit of 200, of which they want to declare 150 to the shareholder. Now, if they declare 150 as profit to the shareholder, let's say there's a withholding tax of 15% on dividend, they have to pay 22.5 as tax on dividend. As against this, there is an alternate way in which they can do a buyback of shares. In buyback, what happens is the difference between the market value or the purchase price, the buyback price, and what was invested in the shares, which is 50 in this case, is taxed as something which I can call as buyback distribution tax at the rate of 20% of this difference. So 20% of this 50 will be 10. So as a company, when you evaluate how you have to make your return to the shareholders, you can either do it by way of dividend or you can do it by way of buyback. Buyback definitely has its own advantage because the tax here is 10. So many companies, instead of declaring dividend, would go for buyback of shares. Of course, there are different set of conditions for both of them under the Companies Act. There may be different things under the RBI. All that you have to kind of look at. And the third one is that if you sell the equity shares of an Indian company, there may be capital gains, which may be taxable. When we talk about CCDs, there are two periods under which CCD have to be considered. One is till the time these CCDs are converted into equity shares. Until they are converted, there's an interest income which is paid by the Indian company to, let's say, the US entity. On this interest income, there will be a withholding tax. But this interest will also be deductible for tax purposes by the Indian company. And therefore, effectively, it might be actually reducing the overall tax liability of the group. Of course, there are conditions to the deduction of this, which is under section 94B. Once this is converted, this becomes equity, and all the conditions that we had discussed here will be applicable. The third form is compulsorily convertible preference shares. Again, on these, there might be dividend which might be paid. The dividend income, the taxability will be the same. Now, there is no dividend distribution tax which has to be paid by the Indian entity, but there is a withholding tax, TDS, which applies on dividend paid on CCPS. CCPS are also treated as equity for the purpose of FDI guidelines, and their conversion into equity is also not taxable. The conversion of CCD into equity is not taxable. The conversion of CCPS into equity is not taxable. Once converted, the implications will be the same, which are therefore equity shares. When you talk about debt funding options, the relevant guidelines are the external commercial borrowing guidelines, non-convertible debentures, redeemable preference shares, or optionally convertible preference shares. All these are treated as debt under the FDI. There is a different set of rules and regulations called the ECB guidelines, which cover this. And there are different rules and regulations as to which sectors can take an ECB, what is the minimum period for which this can be taken, what is the interest rate that can be paid on this, what is the use of the ECB that has been taken. All this is something which can actually require one complete separate session by itself. So we're going to limit ourselves here. But in all these cases, whatever interest is paid, it is subject to tax under the Income Tax Act. There's a withholding tax which is there. And then there's a treaty rate which is applicable. The rate which is the lower under either of these is something which an assessee can opt for. One change which happened earlier in the last few years is that if there is a non-resident who is earning only interest income from India, and the TDS has been deducted as per the Income Tax Act, which means the surcharge, etc., has been applied, then they are exempted from filing income tax returns in India. Let's now look at a few examples to demonstrate what we discussed until now in a more practical sense. So for the purpose of this example, we'll first look at equity shares and the taxation of dividend. So here you have a US company which owns 100% of a Singapore company. And this US company is also owning part of Indian company directly and part indirectly. Now, let's say, for example, this is Singapore. The taxation of all the streams of income, again, like I mentioned, is something which has already been done in the earlier webinar. We will briefly touch it upon here so that the concept is clear for you. So whatever dividend is now declared by the Indian company, the question is this liable to dividend distribution tax? The answer is no. Whether the Indian company declares dividend to a Singapore entity or to a US entity, there is no dividend distribution tax. But there is a withholding tax which has to be applied, the TDS rate which has to be applied on such dividend. So if the dividend is declared by the Indian company to the US entity, the rate of TDS is 15%, where the US company owns more than 10% in the Indian entity. So in this case, because it is owning 49%, the rate of withholding will be 15%. And generally, the way the taxes are defined in a treaty, the surcharge and the cess is something which is not applicable over and above these rates. But let's say, for example, if instead of 49, this entity was owning only 4%, in that case, the TDS rate would be 25%. Needless to mention, whatever TDS is deducted here, if this dividend income is also taxable in US, they may give a credit for the dividend, the TDS deducted by the Indian entity. One important thing which is there in the Indian Income Tax Act as well as most of the tax treaties that India has is that just declaration of dividend does not result in the taxation in the hands of non-resident. Because in Section 9, it says that dividend paid by an Indian company will be deemed to arise in India. Which means that unless and until just because the dividend has been declared and this US entity is eligible does not mean that the taxation is triggered. So therefore, it is in your hand in terms of when do you really want to consider the taxation, and accordingly the payment can be made by the Indian entity. The next question is buyback of shares dividend? No. The answer is no, because there's a specific provision which says that buyback of shares will not be treated as dividend. The other important point is, what if this foreign company receives dividend from India? Will they be liable to minimum alternate tax? Now, here, what we need to see is, when a foreign company receives dividend from the Indian entity, does that foreign company actually have a permanent establishment in India? If this foreign company has a PE in India, the dividend income will be subject to MAT, because that's where you will prepare the MAT as well. But if the PE is not there, then generally this dividend income will not be liable to MAT. And the last question, similar to what I just discussed in the context of interest, is if a foreign company just has dividend income, is it liable to pay, or is it liable to file corporate tax return in India? Here, the important point is, what is the rate at which the TDS has been deducted? If the TDS has been deducted as per the IT Act rate, then basically there's no need to file the ITR. But if the TDS has been deducted as per the treaty rate, which is, let's say, 15% here. In India, that under the Act, the rate is 20%. Then you have to file a return, because that will give an opportunity to the tax office to evaluate whether you're actually entitled to the benefit of the treaty or not. For those of you, I would like to reiterate, for those of you who want to stay connected for more such sessions, you can follow us on LinkedIn. The second question which comes up, corollary to equity share dividend, is, what if there's a transfer of shares? And again, in the context of India-US treaty, the capital gain article is actually very, very small and simple. Simple, but not favorable. So when I say simple, this article just mentions that the right to tax capital gains shall be with USA plus with India, which means any kind of capital gain that arises, India also has a right to tax those capital gains. So when there is a sale of equity shares of an Indian company by a US company, there is a capital gain event that is going to arise. Now, in this context, it would be relevant and within the context to mention that when there is a transfer of shares of the Singapore company, let's say the US company owns 100% in the Singapore company. When the US company sells the shares of a Singapore company also, there could be a situation where indirect transfer provision may kick in. And such a transfer may be liable to tax in India. But for that to kick in, there are various conditions as to what should be the proportion of the value of the Indian assets in the books of the Singapore company and things like that. But if those conditions are satisfied, then in that case, the transfer of shares of Singapore company by the US entity will also be liable to tax in India. And in that case, the treaty that is going to apply will be the India, Singapore or US. If you want, you can comment in the section to say which treaty would apply. So if the US company sells the shares of the Singapore company, there's an indirect transfer of shares of the Indian company. The provisions that are going to apply will be, they will be India-US treaty provisions. Now, insofar as the tax rate is concerned on capital gains, there is no specific tax rate which is given under the treaty. Therefore, the provision or the rate given under the Income Tax Act will apply. And these will be 10% for long-term capital gains and the general tax rates for short-term capital gain. When I say the general rate, so for a foreign company, the general tax rate is 40%. So that would apply. The indexation and the foreign currency benefit are not available on unlisted equity shares if we're opting for this tax rate. But the surcharge and cess will be applied because this is a rate given under the Income Tax Act. And the last question, which again keeps on coming in almost all the discussion that I have with people, is what if this US company were to sell the shares of the Indian company to, let's say, a UK entity at less than fair market value as per Income Tax Act. In those cases, what is going to happen is that when the transfer is done here, the taxation has to be seen at two levels. One is, what is the fair value for computing capital gains in the hands of US company? And we're talking about equity shares here. In that case, you calculate the fair value as per the Income Tax Act. And if the transaction price is different from this fair value, the difference is also going to get taxed in the hands of the non-resident. Sorry. Similarly, when this UK company receives the shares with a fair value of, let's say, 150 for 100, this difference between 50 will be taxable in their hands under the Income Tax Act. But they can opt for the beneficial provision of the tax treaty. And if under the treaty, India does not have the right to tax other income, then despite Section 56, there may be no taxation in the hands of the UK company on this difference of 50. Clear? So under India-US, India has the right to tax capital gains. The rate of tax for capital gains is as per the provisions of the Income Tax Act 1961, because the India-US treaty does not provide the tax rate. If the transfer is done at less than fair market value for equity shares, there's an upward adjustment which will be done in the hands of the seller while computing their capital gain, and in the hands of the buyer while computing their income from other sources. Now here, one interesting thing is that in case of US, India has the right to tax. But if this was a company or a country where the capital gains were exempt, then even though the tax transfer was done at less than fair market value, there would be no impact, because despite the adjustment under Section 50 in the hands of the seller, basically the entire gain will still be exempt from tax. Let's talk about compulsorily convertible debentures. So on compulsorily convertible debentures, there will be interest which will be paid by the Indian company to the US company. The withholding tax rate on such interest is 10%, where the recipient is a US bank, and 15% in other cases. If there's a transfer of CCD invested by the US company into the Indian company, the tax rate will be 20% for long-term capital gains. Now, in the case of CCDs, the period of holding for long-term capital gain is 36 months. In the case of equity shares, it's 24 months. And the general rate for short-term capital gain. The right to tax such gains will be both with India and USA. The indexation and the foreign currency benefit, again, not available. What is important is that you have to see whether the place of effective management of this transferor is in India or otherwise, and are there any limitation of benefits clause under the relevant treaty. For CCDs, again, Section 94B is one of the most important sections which you should see, because what is happening now is that even though you may be having interest on CCD payable by the Indian company. So briefly, how Section 94B works is, suppose the Indian company has an EBITDA of 100 and the interest is 50. The maximum deduction allowed to the Indian company on account of interest to a related party will be 30% of EBITDA, and the taxable income will be 70. Even though the interest was 50, the deduction is limited to 30. The balance 20 can be carried forward, and it will be adjusted in the year when this difference, this interest expense is less than 30%. Of course, there are tax planning and tax strategies around how you can optimize this as well, both in terms of the inception as well as in terms of going forward. But of course, that's a matter which one has to look at as you come to that stage. Now, place of effective management, one of the tools, one of the aspect mentioned, not mentioned, which is being applied very, very seriously right now. So at a legal level, POEM concept is applicable only when the transferor has a turnover of more than 50 crores during the relevant financial year. So if the seller is Singapore company, you have to see their turnover. If the seller is US company, you have to see their turnover. But what the government or the income tax office is looking at right now in terms of our experience, and this is some of the criteria that is being looked at in assessments, is they want to see what is the fund trail of these investments, which means if a US company is investing, is it that they send the money to the Singapore company and on the same day or a day after, they're investing into the Indian company, meaning thereby that effectively the Singapore company has no financial standing on its own. The second question is, whenever they are using an intermediary jurisdiction, what is the management of this intermediary? Is it a local director based out of Singapore, or are all the directors from US or maybe some other jurisdiction? If they are local, even if they are local, what is their qualification? Are they secretarial people who can be arranged for a few $1,000s? And therefore, they might be just signing the documents, whatever come their way, without applying their mind in terms of how the investment is working? Are there actually business people? Business people as in someone who is knowledgeable enough to take decisions. Then the third thing is the documentation of the Singapore company at the time of making the investment are being sought. What is the board resolution which has been passed at the time of making the investment? Does it really has all the capabilities or all the nuances which an independent person would look at? And this is something which, again, after the notices were sent 2-3 months ago to various companies, they're now evaluating and revisiting all their documentation, etc. Even though they may not be selling something right now, people are getting down and evaluating these aspects after notices have been sent out by the income tax office to verify whether they are having a place of effective management in Singapore or somewhere else. And for these board of directors, what's happening is, are they employees of the Singapore company? Are they employees of the US company? What exactly is the thing that has been done? Some of the other matters which are related to the India-US treaty is, India-US treaty has a service permanent establishment clause. This arises when a US company provides certain services to the Indian entity. There's a definition as to which services have to be provided. If these are provided to a related party, then even if these are given for one day, the US company is deemed to have a permanent establishment in India. But if they are provided to an independent third party, then the services should be provided for 90 days before a PE can arise. What if a non-resident Indian or some other non-resident has a immovable property in India that they are selling? Then, of course, there are capital gains. If they are resident of US, India has a right to tax them. One of the other important aspect here is, which I think a lot of clients are facing issues, but it's a process that they have to go through, is if a resident is actually buying property from the non-resident, they have to withhold TDS. For this, they have two choices. Either they get a certificate from the tax office, else for long-term capital gain, the tax rate is 20% of the gross consideration. Because of this, now a lot of residents are actually applying for TDS certificates, or actually NRIs are applying for TDS certificate who are selling properties. The rental income, again, is something which is taxable in India. Insofar as income which is not expressly mentioned, something like income from other sources that you have under the India Income Tax Act, the right to tax is with both India and US. And one of the most frequently used clause under the India-US treaty is the make available clause. Under this clause, basically, what happens is that if a US company provides services to an Indian entity, they are not liable to TDS in India unless and until these services make available technical knowledge, skill, etc. Now, what is make available? Make available in simple terms mean that the person who is providing the services enables the service recipient in such a manner that next time if he has to do the same work, he can do it by himself without actually going to the transferor. That is what is make available. So there's a detailed guidance, examples, etc., which are available under the technical explanation to the India-US treaty on the concept of make available. Now, with that, we come to an end of this particular session. If there are any questions that you have, you can put them on the chat box and we can answer them.